Welcome to the Dev Journal. We are witnessing a fundamental pivot in how machines operate. The industry is moving beyond simple helpers to fully autonomous agents. This massive transition is forcing giants like Amazon, Microsoft, and NVIDIA to completely re-engineer their infrastructure and pour hundreds of billions of dollars into new capital expenditures. Today, we explore Anthropic and their new tool, Claude, which is taking over complex security research with agentic reasoning. We also dive into a provocative look at the future of neural implants. As cerebral links become a reality, we have to ask how artificial intelligence governance will protect the very thoughts inside our heads from external threats.
While those security implications are heavy, the efficiency gains in the laboratory are equally wild. I have been tracking Andrej Karpathy and his latest open-source tool, Autoresearch. It is only 630 lines of code. Plus, we are analyzing Amazon and their 21-day outlook as the partnership with open artificial intelligence reshapes the cloud landscape.
That lean approach from Karpathy highlights the massive disruption currently keeping legacy giants awake at night. The scale of this transformation is staggering, and the technical debt being cleared is even larger. We are tracking the money and the code to see who survives this architectural shift. Our deep dive into autonomous agents starts right now. The landscape of artificial intelligence is shifting from simple conversation to genuine digital labor. We are seeing a 116% increase in agentic autonomy over just the last 6 months. This evolution suggests that tools like Claude are no longer just assisting, but are starting to operate with their own independent reasoning. Consider the recent 2-week pilot with Mozilla Firefox, where the system identified 22 unique vulnerabilities. 14 of those were classified as high severity, proving that these autonomous agents can handle the high-stakes work typically reserved for senior security engineers. This level of output changes the fundamental economics of software maintenance and security. One of the most impressive feats was discovering a decades-old heap buffer overflow in the Common Graphics Interchange format library. By logically analyzing compression algorithms, the agent found a flaw that had escaped human eyes for years. This demonstrates a deep repository-level reasoning that goes far beyond simple pattern matching or code completion.
How does the underlying infrastructure actually manage that many moving parts without breaking? Each task requires an average of 21.2 independent tool calls. Orchestrating that level of complexity safely requires the low latency reliability found in the newly standardized Model Context Protocol for interacting with sensitive databases like BigQuery. I am also looking at how much human-curated context is still required for these successes. The system relies heavily on a specialized Claude Markdown file to navigate project-specific infrastructure quirks and conventions. Without that hand holding from a developer, the agentic reasoning might struggle to find its way through a messy legacy codebase. The introduction of the auto-accept mode, triggered by Shift+Tab, is where I start to get concerned about the stability of the system. Allowing an agent to autonomously iterate through code edits, tests, and terminal commands until resolution creates a significant security and stability blast radius if the reasoning fails. We have to ask ourselves if we are ready to let an artificial intelligence execute terminal commands without human intervention. While the efficiency gains are tempting, the risk of a logical error cascading through a production environment is a trade-off that many cautious architects might not be willing to make. We are pivoting now from the enterprise-grade complexity of Claude to a much more minimalist perspective on autonomous systems. Andrej Karpathy is taking a different path with an open-source approach to autonomous experimentation. His new tool proves that you do not always need massive infrastructure to drive significant technical progress.
The way the chief executive officer of Shopify, Toby Luck, utilized this tiny script to achieve a 19% improvement in validation scores is a testament to the power of simplicity. It suggests that we do not always need massive, complex software stacks to achieve significant business impact when the underlying logic is sound. By keeping the entire framework to just 630 lines of Python code, Andrej Karpathy has created a tool that feels incredibly accessible. It demonstrates that autonomous machine learning experimentation can be handled by a lean architecture that focuses strictly on high-velocity iteration rather than feature bloat or unnecessary infrastructure. Restricting these training runs to fixed 5-minute intervals on a single NVIDIA graphics processing unit effectively democratizes the research process. It allows smaller teams to find neural network architecture optimizations that were previously the domain of labs with massive compute budgets, eventually scaling those wins into production systems.
Sloan, those efficiency gains are only possible because the entire 630-line codebase fits perfectly within a modern large language model context window. This technical constraint is the real genius here, as it virtually eliminates the code generation errors and hallucinations that typically plague much larger frameworks. I am looking closely at how validation is strictly enforced through the bits per byte metric. By requiring the artificial intelligence agent to only commit code changes if that specific performance score improves, the system removes the human intuition that often guides the most creative and risky architectural decisions. While this creates a ruthless environment for optimization, it relies on the assumption that a single metric can capture the nuances of model behavior. It is a highly rigid approach that forces the autonomous agent to justify every change against a benchmark without any qualitative human oversight or review. Despite those constraints, these autonomous optimizations are being successfully integrated back into the larger Nano chat production framework. It proves that a constrained, 5-minute loop can generate meaningful architecture updates that hold their weight when faced with real-world enterprise requirements, provided the objective is sufficiently narrow.
We are now moving from the digital realm of autonomous software agents to the most intimate hardware interface imaginable. We need to examine the emerging security vulnerabilities surrounding the human brain and the serious governance challenges posed by the latest generation of these neural implants. With over 2 million individuals globally now relying on neural implants as of 2026, it is deeply concerning that there are currently no specific cybersecurity standards governing these devices, leaving a vast population vulnerable to digital intrusions that could potentially alter their very perception of reality. The regulatory landscape remains precarious because consumer-grade brain-computer interfaces often fall entirely outside the protections offered by the Health Insurance Portability and Accountability Act, simply because the hardware was not installed within a traditional hospital environment, leaving sensitive neural data exposed to various commercial interests. We must confront the terrifying reality that neural signatures are permanent biometric identifiers that cannot be reset or rotated like a standard password, meaning that if a hacker exploits an unencrypted Bluetooth protocol to extract this data, the unique identity of that individual is effectively compromised for their entire life.
Considering the permanence of those identifiers, we are looking at a massive surface area for exploits, since brain-computer interface authentication systems are currently facing a staggering 67% failure rate when targeted by artificial intelligence-driven neuromorphic mimicry attacks that replicate the unique neural patterns of a user. This high failure rate exposes how our traditional understanding of biometric security is completely inadequate for the complexities of neural data, because these signals are dynamic and noisy, making it nearly impossible to distinguish between a legitimate user and a generative model trained to simulate electrical impulses. The only viable path forward for defending such a complex interface appears to be the deployment of autonomous systems like Tiamat, which is a particular architecture designed to correlate hundreds of different attack vectors in mere seconds to provide a defensive layer that reacts faster than any human. While using an autonomous agent to protect the human brain sounds like science fiction, it is a necessary technical evolution, where these systems can isolate compromised neural pathways before a malicious actor can gain full control over the sensitive data flowing from the implant to the cloud.
As we consider the high stakes of protecting our own minds, we are now pivoting from the technical risks of artificial intelligence to the massive financial capital being deployed to build the infrastructure that powers these systems, specifically looking at the 21-day outlook for Amazon and their open artificial intelligence partnership. The scale of the strategic partnership between Amazon and open artificial intelligence is truly staggering, representing a massive $50 billion investment that reshapes the entire industry. By pairing this capital with a reciprocal $100 billion cloud compute agreement, Amazon has effectively positioned its web services division as the primary foundation for future breakthroughs. This commitment is mirrored by their aggressive capital expenditure guidance for 2026, which is projected to reach an unprecedented $200 billion. It is a bold statement of absolute confidence in the long-term return on investment for artificial intelligence infrastructure. Building on trailing 12-month spending of $131.82 billion. We are already seeing the fruits of this labor as Amazon Web Services revenue grew 24% year-over-year to $35.6 billion. With a relative strength index of 64.64, the market is signaling strong upward momentum towards a price target of $280. While these growth figures are certainly impressive for the top line, the sheer volume of hardware procurement required to maintain this lead is starting to show up in the deeper financial metrics. Vance, when you analyze how they are actually funding this massive expansion, the liquidity profile shifts dramatically compared to that headline growth.
The liquidity profile is more than just different. It is a significant concern for anyone tracking the actual sustainability of this hardware arms race. Amazon saw its free cash flow plummet from $32.9 billion down to just $7.7 billion in the last year, which suggests they are essentially hollowing out their cash. Even though net income increased by 31.09%, the massive capital requirements for server clusters and specialized silicon are creating a ruthless environment for the balance sheet. We are witnessing a fundamental shift, where the core retail and cloud profits are being immediately recycled into depreciating hardware assets at an almost unsustainable rate of speed. While a 50.29% gross margin provides a healthy cushion for now, the recurring costs of maintaining and cooling this massive infrastructure cannot be ignored. The debt required to bridge the gap between that $7.7 billion and the $200 billion in projected spending represents a significant architectural risk. It will be telling to compare this infrastructure-heavy approach with how Microsoft is managing their own artificial intelligence rollout. While Amazon is building the massive digital foundries of the future, Microsoft is focusing much more heavily on software monetization and the integration of autonomous agents directly into their existing productivity suite for immediate enterprise capture.
Microsoft is pivoting toward a high-margin monetization strategy with the upcoming launch of their new $99 per user E7 software bundle on May 1st. This move represents a calculated attempt to turn their massive infrastructure investments into direct revenue by targeting the enterprise workforce with premium tools. Despite a 15% year-to-date decline in stock price, the fundamental health of the organization remains incredibly robust, with a 36.15% net margin. This high level of profitability allows them to weather market volatility while continuing to scale their operations across the entire global productivity suite. With $71.61 billion in free cash flow, they possess the necessary capital to sustain aggressive development without sacrificing their balance sheet stability. Analysts are eyeing a consensus price target of $594.62, which suggests a significant upside from current trading levels. The upcoming April 29th earnings report will likely serve as a massive catalyst for the stock, especially as the market anticipates the impact of these new product tiers. Vance, how do you see their technical integration of external models like Anthropic fitting into this competitive landscape against former allies like Open Artificial Intelligence?
Integrating Anthropic's Claude into their platform is a necessary defensive maneuver, as Open Artificial Intelligence reportedly develops a direct rival to GitHub. This shift indicates that the once exclusive partnership is fracturing, forcing Microsoft to diversify its model offering to protect its dominant position within the developer ecosystem. While their $64.55 billion in capital expenditure is a massive sum, it is actually quite disciplined when compared to the spending we see from Amazon. Microsoft manages to fund these infrastructure requirements entirely through their own operations, maintaining a far more sustainable liquidity profile for their long-term growth. The 5% stock move predicted around the May 1st launch will be a critical test of whether enterprise customers are actually willing to pay those premium $99 fees. If the adoption of these autonomous agents lags, that $64 billion investment in specialized silicon could become a heavy burden on their margins. Ultimately, both of these tech giants are locked in a race that requires a constant supply of cutting-edge hardware to stay relevant. We should look at the primary beneficiary of this massive spending from both Amazon and Microsoft, which is the hardware kingpin currently preparing for its own shift.
That hardware kingpin is undeniably NVIDIA, which has effectively become the central clearinghouse for the entire global artificial intelligence boom. By maintaining a 55.60% net margin that essentially captures over half of every single dollar spent on infrastructure as pure profit for the company. This incredible operational efficiency is paired with a 65.47% year-over-year revenue growth that continues to defy traditional market gravity, while the upcoming conference and the Vera Rubin platform launch represent the primary catalysts needed to break the current neutral consolidation in the market. Investors are currently looking toward that average analyst price target of $266.35 as a realistic milestone, since the company recently invested $2 billion into partners like Lumentum and Coherent to ensure their optical interconnects are ready for this massive rollout.
Sloan, although those shiny revenue targets look great on a slide deck, the sheer weight of the supply chain commitments at NVIDIA is staggering, because they have reached $95.2 billion in purchase obligations, which proves that they are betting just as heavily as their customers. We also have to account for the fact that their inventory levels rose by 8% during the Blackwell transition, while the high beta of 2.38 makes the stock twice as sensitive as the market average to any potential shifts in broader technical investor sentiment lately. The technical hurdle now is whether they can actually deliver on that $78 billion revenue projection for the first quarter, while maintaining a 71.07% gross margin, because that leaves very little room for any execution errors in their extremely complex manufacturing process. Even with a forward price-to-earnings ratio of only 16.92, the market is pricing in near perfection for these upcoming product cycles, which could lead to a cooling effect if the software layer does not evolve as fast as the specialized silicon being produced today.
The stakes could not be higher as we watch this unprecedented infrastructure build out reach its next critical phase, because the rise of agentic software is now the primary force driving the largest capital rotation in technological history, by shifting billions into the hardware that powers future machine intelligence.
Seeing Andrej Karpathy boil down autonomous machine learning experiments into 630 lines of code, alongside Anthropic deploying Claude code for security research, shows the shift is happening. These are not just theoretical wrappers anymore, but actual tools executing logic without a human holding the steering wheel through every single step of the process.
advance those specific technical milestones you mentioned really illustrate the broader strategic pivot happening across the entire industry. Transitioning from assisting a developer to acting as an autonomous agent is what justifies the massive capital expenditure we are seeing at Amazon and Microsoft, while software begins to reason and iterate independently in this new era. Thank you for joining us as we navigate this unprecedented period of technological change and market rotation. We hope these insights help you understand the deeper architecture behind the daily headlines. Until tomorrow, keep your code clean and your models sharp as we continue to track the evolution of machine intelligence together here on the Dev Journal.